Your Excellencies, ladies and gentlemen, it's my absolute pleasure to welcome you all to our UK UAE Knowledge Sharing Summit on Private Wealth, Family Offices and Sustainable and Impact Investment, with thanks to our sponsors, First Abu Dhabi Bank. For those of you who don't know me, my name is Kalfa Talib. I'm the Head of Policy and Campaigns at the UAE UK Business Council, and we're delighted to be hosting you today at the Climate Hub at the Heriot Watt campus here in Dubai. So thank you all for coming. There is no better opportunity to address the role of finance and investments in bringing about solutions to the issues that we face today. To begin today's event, would you please join me in welcoming to the stage Professor Richard Williams, Principal and Vice-Chancellor, Heriot Watt University, to say a few words of welcome.
Well, thank you very much, and it's a great delight to be able to welcome you here to Heriot Watt University. And it's been a great pleasure of mine to be one of the co-chairs of the UAE UK Business Council in the area of education and innovation. So you are indeed so welcome here. Heriot Watt University is a university that started 202 years ago, in fact, in Edinburgh, and we have around 30,000 students in 5 locations. About 1/3 of our students are in the UK, and the rest are here in Dubai and in Malaysia. So just to say, you're really most welcome. I hope that you enjoy the time, and how much we need to do in universities to support gaining confidence and ambition that we can do climate change. I've been doing a few interviews this week, and people said, do you think it's possible, etc., etc. It is absolutely possible, but we need to increase people's confidence and ambition and map out better the pathways through which we are going to achieve it, so people can understand it. And we know it needs people, we know it needs technology, and of course we know it needs money. And I'm sure that's what we'll be talking about today. So thank you.
We are delighted to be working side by side with Heriot Watt Climate Hub throughout COP28 and hosting today's event on private wealth and investment. We are also very, very grateful to First Abu Dhabi Bank for supporting today's event. And indeed, First Abu Dhabi Bank have been great supporters of the Business Council, and they have done an enormous number of things with us, so we are really grateful to them. We bring, as a Business Council, business leaders, academics, entrepreneurs, and we work together in both countries. And very roughly, we're about half our members are Emirati companies and about half are UK companies. So we very much work as a partnership. It's all about collaboration. And it's about the opportunities that exist in the two countries both ways. And if I stray too far on the British side, my colleague, my co-chair, will quickly pull me back the other way. But we make sure that we are equal-handed in what we do. And the potential for today is always about private wealth, and it's about scaling up impact investment, sustainable investment, and that's been a major point of discussion at COP28. What the UAE and the UK share are very strong ecosystems for enabling this pivoting of private wealth towards investment portfolios, where ESG is a more prominent feature. But with that change of focus comes risks and challenges. Today's panel discussions will address these issues and also explore how our two countries can work closely together to share best practice and expertise. As a Business Council, our role is also to inform our governments about the concerns and interests of our respective business communities. And with that in mind, we are delighted to announce that early next year, we'll be writing a policy paper summarising the key points from today's discussions and setting out recommendations for closer collaboration between the UK and the UAE on private wealth and impact investment. This paper, which we will produce in collaboration with some of the companies and organisations represented here today, will then be submitted to both governments for consideration. So your participation in today's events plays an important role in shaping bilateral engagement in this area. And I would add that we will probably aim to produce that paper in time for the joint ministerial meeting, which will take place early next year between the UAE and the UK. Probably it'll be taking place during the World Trade Organization meeting in Abu Dhabi, which is in February next year, end of February. That is probably the timelines that we're working to, because that's when we know most of the key ministers from both countries will actually be together, and that's really the opportunity. I also want to conclude by mentioning that the trade and investment relationship between the UAE and the UK passed a most important milestone this month, last month rather. Bilateral trade is now worth 25 billion a year, an increase of 47% on last year. The UAE is the UK's 19th biggest trading partner and its 12th largest export market. So you can see how incredibly important the trade and investment relationship is between our two countries. But when you think about how we can enhance this trade even more in the future, the answer inevitably lies in developing a new partnership in sustainability in every industry. Sustainability will become an increasingly important driver of growth, and the private wealth sector is critically important in unlocking this potential for growth. So with that in mind, I look forward to hearing the discussions today and to supporting your efforts to build new partnerships between the UK and the UAE in private wealth and impact investment. Thanks very much.
Excellencies, ladies and gentlemen, good morning. It's a real pleasure for me to be here today on this very busy week, I must say. I would like to start first by thanking the UAE-UK Business Council, who is we are very proud to be associated with on this occasion and many others. And we want to continue on this very fruitful cooperation. Obviously, the Heriot-Watt University was welcoming us today. And I think the purpose of this day is to really share experience, share ideas, and how to tackle climate change issues as part of investments, as part of the way we should invest. What I've seen in this COP is a very strong change of mindset, which we can see, which we can feel in many of the commitments. And one of the most important one, obviously the most important so far, has been this creation of the fund, which is funded more than 30 billion by the UAE, but is now bringing more assets. And hearing from Mark Carney about this yesterday, I think the target is to reach almost 250 billion in this fund, which will be a major change in the way we finance, let's say, all these changes that are needed. So this is a major, let's say, global commitment. But I want to mention as well what was announced yesterday on the UAE banks, not only FAB. The UAE banks have committed for financing of 1 trillion dirham, and all the banks have been on stage on this commitment. We will do our share as the leading bank in this region. We increase our commitment from 75 billion dirham to 135. So it is more than important, I would say, and more than significant in terms of impact that we are aiming at this. This front page here is the front page of our ESG report, which we are the first bank in this region to publish. And I really, you can find it. It's a public document. Very interesting one about all the commitment of the bank. So I don't want to spend too much time, but I want to give you a picture of what is FAB today. We are let's say, the leader in this region, the local bank with a 30% market share. We have a global balance sheet of around 300 billion. What is very important to us is that we are the partner of the whole ecosystem in this region, in particular all the global and the governments, and also the main family offices in this region, which is the scope of today. We have what is very significant for us is that we are the most solid bank, which with a AA rating, which has been reconfirmed. And we are considered as one of the safest bank, not only the safest bank in the region, but also in the top 50 in the world. So as part of the global presence of UAE in the world, we are both a local leader, but also a representative of that region globally in the world, and we support most of the UAE initiatives which are in the region and outside. As just a brief introduction of our businesses, we are in four main businesses: investment banking, consumer, corporate, and global private banking. These are obviously we are a total universal bank. What is very important for us, and that's the bridge also to our ESG commitment. First of all, we are a bank of around 7,000 people with a strong engagement in order to have a full representation, inclusion, and a very large talent pool in the UAE and outside. We have a very diversified business model. We have very long-term, obviously, relationship with Abu Dhabi government and government-related enterprise and all the largest institutions in the Middle East. We have a strategic international network in 20 countries, and to make the link with the purpose of that day, we are also one of the regional performer in terms of ESG with commitments we started several years ago. On this specific topic of ESG, as you can see, it did not start recently. We started some years ago. We have today, in terms of financing, more than 35 billion, which already committed in sustainable financing. So that's this amount that will grow to 135 billion in the next years. We have a let's say around we try to be respecting, let's say, the ESG commitment, and in particular we have been the first bank to join the Net Zero Bank Association, which is one of the initiatives among the global banks in the world. We were also the first to issue green bonds in this region. Our approach on this sustainability, and it's to make a link with the debates that will happen today. We have commitments which are linked to the SDGs. First of all, the transition to a low carbon future. So as a regional leader, we want to embed, and we are embedding this in our decisions in the bank, and we will very soon. We are already net zero as a bank, but I would say we are not. It's not difficult to be net zero, because at the end we are just taking some planes, and we have air condition. But that's not the most difficult one to be. So it represents only 5% of our commitment. But when we move to scope 2 and 3, which represent the 95%, which is what do we finance, how much impact does it have on carbon emission. Clearly on this, that's where the commitment is. And we have a global commitment to reach net zero by 2030 for scope 2 and 2050 for scope 3, so which is the impact of what we finance with the different companies that we are financing. We also put a lot of emphasis on social responsibility in this region, and there is a very strong management in the bank of diversity, of gender diversity. We also have a emeritization focus and a strategic focus on financial inclusion, and that is part of our at the executive committee a commitment that we take with our stakeholders and our staff. And finally, in terms of governance, we have also a specific focus on ESG risk in all our decision, not only on our investment ourselves, but also what we do with our clients. This is the journey that we have had so far in the let's say the net zero target. It started, as you can see, already more than 13 years ago, But the main milestones here were the commitments that we took in terms of financing in 2016 to reach 75 billion of this of financing, which is already half reached, but it now increased. We were the first bank, as I said, to issue a green bond in 2017, and we are committed to really move to and to be part of all the initiatives, as I said, about the Net Zero Bank Association. The targets that we have for 2030 and 2050 are aligned with the global targets of the UAE, not only on what we do, but also on what we finance in order to reach this target in 2050. And we have also started and implemented the TCFD, our first TCFD report as well. The way, obviously, when we speak about investment, and we are here to speak about this with what do we suggest and how we advise or how we work with family offices, we have to look at the global market of ESG investment. It's growing fast. It will reach a very significant size. We see that the interest in our client base is growing. Not only maybe before we were expecting to change in the new generations. In fact, it's also, I believe, a very strong commitment in the older generations, which are the majority of the clients. And that's why we have developed an offer globally on the ESG investment. And here, what we want to offer, what we want to achieve, first of all, is to help our clients to reduce risk. I think it's a risk today to be overcommitted to investments which are not aimed at reaching or fighting climate change. And that is something that we need to take into account in our decisions, in our investments. Second, obviously, we need to deliver returns. And I think today, delivering returns, investing with ESG criteria is possible. We see a lot of potential investments into and capital deployment into sustainability, renewables, which are excellent investment opportunities, and we should not look at this by, let's say, an investment that does not make return. It will make return, and perhaps some of the most interesting returns in investment in the next 20 years. And finally, it's a change of behavior, which everybody wants to achieve, and where our role is to also to offer this capacity also to contribute at an investment level, at a family level, to this change in behavior. The landscape of the offering in terms of ESG product is quite large. We try to offer all the options that are available today, not only the traditional one or the ones who are well known, but more and more we develop specific structures, specific funds, specific expertise, and we have expertise here. We are launching these days our SDG fund, which is replicating all the SDGs, and that's one of the strong initiatives. But in all areas, we try to have solutions which can be deployed by people who want to go in that direction, and clearly it's our focus to bring them, to give them access to all this. And just to conclude, I think it's a commitment that we have on our side, which is driven. It's a strategic initiative. It's not a side initiative within the group. It's a value-driven because it can deliver the future of growth, and a big part of the future GDP growth in the world will be driven by these initiatives. And it's also something that is a bit beyond banking, because it's also part of values, part of commitments, part of behavior changes that we want to promote. In a bank, we do three things. One, we provide financing for all these initiatives, and as I said, we will deploy more than 100 billion dirham in the next few years. Two, we are, as an investment banker, corporate finance, we orient capital to the new initiatives. And three, as a wealth manager, we invest in this change. And these are the three areas in which we are committed to our stakeholders and our clients. that is what I wanted to just to share as an introduction to FAB, and I now will leave the floor to the panel. Thank you very much.
I would like to extend my thanks particularly to His Excellency Ahmed Al-Sayah and Lord Adney Lister for tirelessly championing the Business Council's cause, which is so important, fostering the warm political and business relationships between the UAE and the UK, which we all so cherish. Thank you to Bradley, Kauthar, and all of the team at the UK UAE Business Council for inviting me to moderate this important panel today. And we wouldn't be gathered here today without the fantastic support of both Heriot-Watt University and First Abu Dhabi Bank, our kind sponsors across this whole series of events. What do we mean by ESG, and how might it be differentiated from CSR or impact investing or other terms such as that?
I think definitions are important because they set expectations. Basically, knowing what to expect when you're talking about impact investing is different from what we're talking about when we talk about ESG. And mindful of the presentation we've just seen, I think it's also different it's important to differentiate between labeling something an ESG product and ESG as an investment agenda. And what I mean by that is that I think there is a broader expectation that investments and asset allocation, the shifts in capital, start to address what I would call externalities. And by externalities, I mean, frankly, the sustainability landscape. So if we say the sustainability landscape is all of the big systemic risks regarding social, environment, and to some extent governance issues, there's a broad landscape. If we're talking about impact investment, generally you're focusing on a specific impact. And the history of impact investment has frankly been challenging because of that balance between how do you measure progress on the specific impact against the need to generate returns. I think moving from specificity to broad systemic risk considerations is key. And for me, in terms of our engagement, we spend a lot of time saying, okay, how do we start to embed thinking on systemic risk, which is what I call the ESG aspect, into investment policy?
I think with that sort of starting position, let's consider first the positives of an ESG-led approach then. So we're going to talk about risks in a minute, but let's start with the benefits. Why is this so important to us? And I think studies have shown that companies with strong ESG credentials, and again, those that are thinking and operating systemically, as you say, John, tend to have much better long-term financial performance. So integrating ESG considerations into private wealth management can therefore create much more sustainable and resilient investment portfolios in the long term. So maybe if I could turn to Aladdin, from your perspective as head of global private banking, MENA, what do you see as the key benefits of integrating ESG into a client's investment portfolio? And what are the risks of not doing so at the same time?
So just going back to your question on investment, I mean, clearly, as a financial institution, maybe even on the HSBC level, before we go into the private bank, I mean, obviously, we take sustainability very seriously. It's actually one of the 4 key strategic pillars of the group. And that translates, so it comes top down and translates to everything that the bank does, both on the financing side and on the investment side, to how we can support our clients to transition and to really invest in a sustainable way. So I'll give you a framework in terms of how we think about it. Clearly, the sustainability is a secular growth trend. So this is not going away. This is long term. It's happening. It's happening now, and it will continue. And it's not as it used to be, where you will invest in something sustainable and accept lower returns. I think where we're going is to be investing sustainably, but also to generate the returns that the clients expect, and also to protect the investment portfolios. And going back to the investment landscape, clearly there are a lot of political risks, geopolitical risks, interest rates, macroeconomic risks. But in essence, if you look at the ESG as an investable space overall, you have government policy, you have public funds that are being deployed, you also have regulators who are putting pressure on companies to behave in a certain way. And then you also have the consumer behavior. So that's an important thing to keep in mind. So as we think about investing, it's very helpful to have a secular growth trend. So when you deploy capital, you know that this, obviously we will have ups and downs. It's not a straight line, but this is something that will not change. And we look at investing in ESG as one will protect it's a defensive strategy, so protecting portfolio. It helps us identify opportunities. So that's also key. And it will generate substantial returns, so good risk-adjusted returns.
Fuad, if I may, at FAB Private Bank, have you noticed a change in consumer preferences and attitudes towards ESG impact and the risk and opportunities associated with that?
Thanks, Declan. Yes, absolutely. We have seen this. And obviously today I took a few notes here. Every bank has to take this into account in identifying the opportunities, but in also taking care of the risks involved in here. So first of all, if I start with the opportunities, we see more consumer prioritize sustainability and ethical consideration. There is a much higher demand for ESG investments today. It started a few years ago, but today I think most of the consumers are looking into it, whether they are convinced they want to go ahead with it, but they are looking at this, and they are looking at this in a very serious way. This will definitely create opportunities for portfolio growth, as companies with strong ESG practices are increasingly valued by investors. They do enjoy brand reputation and customer loyalty for sure. Investing in such companies will provide opportunities for long-term value creation, as positive public perception contributes to business sustainability. So this is really what I see on the opportunities. In terms of risks, here we can look at two kinds of risks mainly. The first one is the reputational risk. A negative public perception will result in the reduced demand for products and services, impacting the performance of associated investments. There is a different type of risk also, a second one. This transition is a costly exercise, and we know that it is costly, and there are a lot of operational changes that should happen for those companies. This is why what we advise our customers and our clients is before investing to really look at those risks associated with the company's ability to go through a transition without compromising at all on the financial performance. Because what Aladdin said before, today clients are not just looking for sustainable products but also for performance. Today we reach this level where they need both this sustainable aspect but also to get a proper performance. And finally, I would say on this point, it is crucial to consider ESG factors as part of a long-term investment strategy. And here we're not just talking about the short term, where we might see fluctuation in consumer sentiment that could occur. However, we should put a focus on companies with sustainable business practices that will contribute to long-term portfolio resilience for sure.
We've talked about long-term sustainability. We've talked about portfolio growth. We've talked about diversification as well. All of these are really, really important things. And Fuad, you touched there on some of the risks, particularly around reputational risk. We also talk about ethical risk and making sure that you really understand who your partners are, who you're investing with, and there's no sort of further downstream supply chain risk there as well.
With regards to the risks, I think I would like to break it up in different types. Firstly, I think for all banks, and being a banker, at least I can mention that firstly, the bank, we have to be in, we are in a bit of a dilemma. And let me explain what I mean by that. We have to also understand that currently, for all the banks, having different stakeholders and managing the stakeholder management, as well as going green, are two different verticals that we need to work on. For example, let me explain. As long as the shareholder value is intact, and in terms of the annual budgets and the targets that the banks want to achieve, and the brown assets are yielding revenues for the bank, it's very difficult to look at that and say that we want to go green overnight. So we have to balance it in terms of looking at the agendas of the bank, as well as the agenda of the stakeholders, as well as the agenda of the clients on how we do the transition. Vis-a-vis, there could be some social and economic risks if we tomorrow go and say that overnight all the banks decide that we're not going to give loans to coal mining, for example, or to various other factors. That could have some social as well as other economical situations with potentially people losing their jobs. So there has to be a balance that needs to be brought in. And those are the risks that is important in terms of looking at the bank's overall balance sheet, as well as looking at the stakeholder management. With regards to wealth management and investment, I think that was one of the points that you mentioned. It is increasingly we're seeing that investors are looking at the ESG investment, looking at how do we build that in our portfolios. Having said that, as core component of any investments, we should look at diversification. And currently, with the universe of ESG investments out there, unfortunately are limited. So in terms of looking at our overall model, that could be a potential risk in terms of that you might have concentrated positions rather than if you want to do only ESG and not look at the overall portfolio. So it could be a value added that we need to bring in, but in terms of to get to a fully diversified portfolio on ESG perspective, I think that'll take some time for it to build. So I think that's another risk that a lot of our clients are looking at. Of course, the other issue that we face is greenwashing. As much as we want to ensure that our clients invest on the ESG front and investments, how do we ensure that the underlying values are inculcated and I'll put in place, are efficiently managed in that perspective? So that's another risk that we need to sort of ensure that we manage. I hope that sort of helps in terms of the risks that are out there.
With that broader lens in play, what are some of the other factors that fund managers and investment managers must balance with ESG-related decisions?
The point you've hit's really important because it gets to the commerciality and the reality of running a portfolio. So when I think about the risks of embedding ESG, that it's a series of risks that look like mismatches of expectations between investors, fund operators, investee companies, in terms of a number of things. And they're very, very practical and tangible. They're time horizons. So that the time horizon needed to deliver a truly sustainable transformation it can be very, very different to the investment time horizon for a particular portfolio or fund. So if you need 10 to 15 years to deliver transformation, and yet your investors are looking at a 2 to 3 year time horizon, the ability to have that mismatch, or the fact that that mismatch exists, is one of the core risks that you have. There's a risk around substance versus form. And so part of the ESG movement, of course, started with the idea of negative screening, that you would screen out particular industries in their entirety from participating in a potential transformation. And that remains true with some industries today. But it was a very blunt way of doing things. And then you've moved on to the idea of ratings agencies providing a helpful role in constructing portfolios and selecting investments. And yet nearly everyone has access to the same data. And frankly, some of the measures in those are not as robust as they could be, but particularly around things like governance. So the ability for an investment manager or fund manager to get to the substance of ESG matters really is what will discriminate outperformance from a more regular performance. So yeah, the returns, the substance, the time horizon, all play a part there. And I think they're complicating factors. I don't think they're straightforward, but the ability to execute an investment strategy around those is how you overcome some of those risks.
Wherever we see good money flowing, so wherever there's lots and lots of government funds, there's lots of investor funds in large volumes, there are always those more nefarious characters looking to profit from ESG-related activities. And at Themis, we've tracked some high-profile fraud cases where well-known fund managers have sold themselves on the international stage as impact investors, and then they've proceeded to steal hundreds of millions of dollars for their own gain. I'm not going to mention any names, but I'm sure many of you in this room sort of know some of the cases I'm talking about here. But we've also seen examples where organized crime groups are committing environmental crimes, and particularly relevant for the discussion we're having this week at COP, such as the illegal trafficking of wildlife or profiting from human rights abuses such as forced labor and human trafficking to lower their production costs and increase their profits and returns. So I'd love to turn to all of the panelists here and ask for your take on these risks. What are some of the key criminal or environmental crime-related threats that you need to consider when looking at ESG-related investments or their supply chains? And how do you mitigate some of these risks as well?
The gold value chain has had its problems and challenges, and we generally, when we talk about the risks we are talking about what we call the informal sector, which is informality at best. What it is basically is where responsible sourcing fails and where responsible business practice fails. But it's very important, I think, in the broader geopolitical landscape to contextualize that. It is usually in places where there's limited capacity, limited resource, lack of rule of law very frequently. It's usually also where there's extreme poverty. Now, from the gold supply chain, we spend a lot of time on responsible sourcing, chain of custody. It is on the responsible mining side, it is a heavily regulated industry. Yeah. There are very well-defined standards in place to define the responsible supply chain. So if you're an institutional investor and you're investing in gold, you're investing in something, frankly, that's in what we call the good delivery cycle. It's a closed cycle. That is where the standards exist and we can show performance. The challenge is where it doesn't. Now, the reason why that's significant in the concept of COP is I would also say that's where often you need to find a way of catalyzing positive change. And so if we talk about the just transition, for instance, in the global south, developing and frontier economies, how do you start to initiate or catalyze, incentivize those governments or those local actors to move? So I'm going to bridge from your question about potentially illegal or certainly dubious activity to talking about actually the need to consider how responsible corporate actors can initiate or catalyze change in areas where governments may be lacking resource or often political will. And that for me is key in this context, because if you have a responsible actor, particularly when it comes to gold, where you've got, frankly, an industry which can underpin the whole economy. 26% of Ghana's foreign earnings are gold, Papua New Guinea, etc. If you have responsible businesses there, basically introducing positive action, both on responsible sourcing, but also on climate action, you can actually catalyze and incentivize change. And I think that's really important. So it's not just about looking at the very dubious negative risks, it's how to incentivize positive action. And we spend a lot of time in the gold value chain talking about that because, frankly, in many, many countries, we are the actor bringing the transition to that local economy. I know I pivoted from your question, but I thought in this context it's worth mentioning.
Very important. We've also got the opportunity to positively impact others. So if we can ask and challenge the right questions, then that creates that ripple effect there. Okay, would any of the other panelists like to comment on the sort of the threats or criminal activities that you need to be wary of when looking at ESG?
Maybe I'll answer a bit differently, and I talk more about how we have to discuss all this with the clients to integrate this ESG within our portfolios, taking into account those risks that we're talking about. And here I think it's extremely important to do a very deep dive assessment, I would say, of the client, to understand first of all what is he looking for, what are his values, and what are his goals, keeping in mind the risks that are involved in all this. Yeah. I think by doing this, we will be able, or the financial advisor will be able to develop a customized ESG investment plan for his clients. Also, those financial advisors, in my opinion today, to ensure that this ESG investment are well integrated, they should be well integrated in a very much balanced and diversified portfolio, okay, to be able to provide the stability and to be able eventually to provide the performance that we were talking about also. And obviously, it goes without saying, today financial advisors are using ESG ratings and research. They are collaborating with ESG specialists, and I think today it is extremely important. But again, to go back to basic, I think that the most important point is the communication and the education of those financial advisors, that I think it's their obligation today for any financial advisor is to educate, quote unquote, their clients. And when I say educating their clients, is also to expose, you know, the evolving landscape of ESG investment. I think this is with the risks that come also in some instances, and the impact of the portfolio performance. So basically keeping a very open channel with the clients, keeping this educational, at least at the beginning, so that everybody really understands what we're talking about, I think it's crucial to avoid risks, whatever you mentioned, and other types of risks also.
Anyone else want to venture a thought? John?
Yeah, I'll touch on it briefly. I'm sitting here looking at the wonderful images of wind power and solar power, and I'm mindful ESG is not, there's a phrase, carbon tunnel vision, that we run the risk of focusing purely on the decarbonisation of the economy. But the commitment to 3 times renewables from 118 different countries looks like something like a $4 trillion investment between now and 2030 that may lead to unintended consequences. And that, when you look on that demand side, could be everything from government frameworks for accelerated permitting to be able to deploy renewable energies, right? So what does that mean to landholders, stakeholders, biodiversity, other plans? Integrating these nested issues is tricky. You then look at supply chains, and you look at where the raw materials come from. So building on the gold example as well, how much integrity is there in supply chains, and how do you ensure that fair work practices and procedures are followed? More than that, how do you reskill potentially workers from one industry to another to take advantage of the economic opportunities are there, and who wins those contracts? How are they awarded? So I think you can make it very practical, looking at the growth in renewables and saying, well, actually, if I'm cautious, I can spot opportunities where things may be mismanaged, and if I approach it integrating those ESG issues, which are always nested, if I approach it with those issues, I can start to probe and do really good due diligence in the investments that I'm making. And frankly, I think due diligence is the key when you're talking about, you know, really making good, actionable investment decisions.
Clearly, as financial intermediaries and banks, we have a duty of care, fiduciary responsibility to our investors. And I think there is a lot more that should be done on the transparency side. And this is obviously something we're investing in terms of due diligence and across our investment platforms, investment products. But that's an area where I think there will be much more innovation needed and much more investment to make sure that we can protect the investors.
At least what we've seen in our bank as well, what we've seen is that one thing is top down and one is bottom up approach. Top down is, of course, to have senior management to set up goals for our teams, our investing RMs and their understanding. But at the same time is upskilling, which is what the point that you were saying, is that how do we upskill their knowledge and understanding so that becomes part of their sort of daily understanding and bringing that to our clients. So I think that becomes very key in terms of upskilling them. I think that's very key. Vis-a-vis, I think the second part that I wanted to mention is, one thing is upskilling our internal teams, and the second thing is making sure that our investors are also understanding and upskilling their knowledge and understanding and bringing their standards to light. I think that helps in the overall grand scheme of things. And that's collectively when all of us are moving in the right direction.
So a couple of you have talked about reporting and ESG ratings and metrics. So I want to touch on that a little bit, if I may. So, we hear a need for more standardized reporting, better data management to ensure the impacts of ESG decisions are correctly measured and communicated. And that can be really, really hard. To actually measure the impact of a portfolio can be very, very difficult. So maybe, Aladdin, if I could start with you, how can we better report to clients on the outcomes of their sustainable and purposeful investments, and what approaches, tools, and other elements do you need to support you with that?
Look, I mean, obviously, reporting is a key part in terms of measuring success. And this is where, as I said before, historically, it was almost you have to suffer returns to invest in sustainable investments. So kind of this double win or triple win doesn't really work. And now it's much more different. And I think what will help a lot across the board, not just on the reporting, is really innovation and technology. And this is where I think this is what's really gonna solve this. And you see this not only pushing companies on reporting, disclosures, transparency, but being much more systematic about how we do it and consistent across the board, because there is a lot of abuse, over the years, and it's improving, but it will take time. But also, again, kind of a bigger picture point. But there is kind of a timing effect to all this, right? So whether it's, the climate problem, for example, it's urgent. It's not something that we can solve in 10 years' time. So it has to be now. And how investors think about returns, it's, there's a mismatch in terms of the timing. And again, I think really this is something that a lot of investment into technology and enablers, the catalysts that will drive change, because you need to get into this tipping point economics. So the tipping point concept is where you go, if you can scale enough, your marginal cost goes down substantially and you attract more investment, and that's like a virtuous cycle.
One of the points that's often missed is what it's for. What actions are you trying to inform from the data? And one of the big challenges, and this, I'm not going to go on a kind of ratings agency bash, but one of the challenges of ratings agencies, they're rankings based on snapshots. Now, when it comes to climate and when it comes to, increasingly you'll hear nature and biodiversity mentioned, a lot of it is intentionality. What is your planned change? What are you going to expect in terms of future performance and future impact, which frequently is not captured in ratings at all. So basically, ratings are static, usually backward looking, whereas we have to be forward looking, and that's one of the challenges. And then the question is, how is the data consumed? And I can tell you now from talking to a lot of different companies, they often don't understand when they're reporting how their data is going to be consumed by ratings agencies. So the question of being mindful of the intention, being mindful of the future plan and the future impact is probably as significant, if not more so, than the current snapshot of data. And I think that's quite significant because that's what investors need.
Recently, we've seen massive advances in the reporting and disclosure space in Europe, in the UK, as recently as last week in terms of the FCA's most recent guidelines being formalised. One of the principles that I think John was hinting at was the idea of truing up forward and backward looking information so that you can form a view as to the quality of disclosure, but also the quality of operation within companies and within investee targets. And as that flows through into the banking system as well, how that data is taken from a point source at a company through to a portfolio level and disclosed becomes very, very interesting at an aggregate level. Because you start to be able to see what really drives risk, what drives performance in a holistic way to the point about where is data used, how is it consumed.
What are some of the strategies and tools that banks and financial advisors can help employ to help their clients navigate the risks of ESG investing and aligning with both their values and their financial goals, as you said earlier?
For example, on the Swiss side, I work for the Swiss entity of FAB. Today, the regulators, the FINMA, have put in place a lot of things in terms of regulations, in terms of transparency, in terms of better understanding and applying ESG factors, which we as a bank are very much abiding to. And we are doing it already. For the 1st of January, we will have this thing about the ratings of clients, about also training our employees, our staff, to become more and more well-versed in this space. Okay, so we have consultants who are in-house today to train our employees to do all this. So all this, I think, is part of how will be limiting the risks involved in this universe. This is what I can add, really.
Just before I close, I'm going to ask each of the panelists just to give us their 1 to 2 second sound bites, any parting recommendations from all of our panelists today. So maybe, John, if I could start with you.
I spent a long time in the family office space looking at asset allocation. All of the portfolio optimization tools, all of the investment strategies that we had are not going to work sometime in the future because the scale of systemic risks are going to change the landscape. So becoming aware, informing your clients, informing yourself, I think is number one. I think it was a great question. For me, systemic risk and the systemic risks that are to follow, that are around the corner, just over the horizon, that changes the whole investment landscape.
It is an ever-changing environment, and I think upskilling our team as well as collective agenda with our clients is the key, and I think we have to work together in that. That would be my point. Yeah, thank you.
Hopefully it's not too negative, but clearly, look, the challenge is huge. It's a big challenge. Clearly, energy consumption is not going down. It's going to go up. The population is increasing. The standard of living is going up. So the solution is really going to be everyone has a part to play. Policymakers, governments, private investors. I mean, all of us. Everyone has a role to play. And just to finish, maybe more positive, it's the technology is what's going to save the planet. So that's really where we need to invest.
I started off talking about negative screens and those sorts of things, and we're talking about risk in ESG. I think the opportunity is here now to optimize for returns and quality in ESG, and I think that's where the conversation can go. Specifically in the private wealth area, yes, you've got public portfolios and you've got companies that are going to be subject to making disclosures to stock exchanges around the world, but private wealth has access to different types of products where the obligation, as you put it, or the opportunity for financial institutions to ensure that quality is there by doing the due diligence and taking a view on what good looks like over time is going to be key to finding out performance.
Education, transparency, diversification, adaptability, and agility. This is what we need.
What I take away from this is a panel of bankers and investment managers who are really proactively looking forward to ESG investing, this isn't something that is an afterthought. This is very clearly a forward-thinking, long-term strategy. And that's really, really important because that's not the case 10, 15 years ago. To our panelists, thank you all very, very much. John, Naushid, Aladdin, John and Fuad, really, really interesting discussion. Thank you very much.